Welcome to the Creating Wealth Show with Jason Hartman.
We have a fantastic episode for you today. This is a big one. This is Richard Duncan, who's been on the show many times over the years. And when I was in Thailand, I looked him up and connected with him because I wanted to do a live interview. So this is kind of a special episode today. And Richard is just so knowledgeable. He knows so much about the economy, and he has this awesome service that you really should subscribe to. He's not a sponsor. I'm not getting paid for saying this. I get no affiliate fee or anything, but it's called Macro Watch, and it's great. He's going to make an offer later in the show. I've been following his Macro Watch for many years. He just does such a nice job organizing information about the global economy, and it's just a really good thing. But you're going to learn a lot from this interview. It's very insightful, and I think you'll really enjoy it. So here we go. Greetings from Bangkok, Thailand. It is unusual that we do in-person interviews, but today we have one because none other than the famous Richard Duncan happens to live here in Bangkok, and I reached out to him. He's got a great new book out, The Money Revolution: How to Finance the Next American Century. I listened to this on audio right when it came out. Has that been a year now, Richard?
A couple of years.
Oh my God. Okay. Time flies. But anyway, it's a pleasure to have you, Richard. Thank you for joining me. It was quite an experience to get here and to meet in person, but I really appreciate it. It's great to see you.
Yeah, Jason, it's so nice to meet you, and such a surprise to meet you for the first time in person in Bangkok, of all places.
I know. You were originally on my show, I want to say 2009, 2010. I think we did a second show around 2011, and we talked a lot about coming out of the Great Recession and so forth. You know, Macro Watch, your educational membership program, is fantastic. I learned a lot from it, and we've had you on the show several times. And now there is so much to talk about. The Trump administration 2.0, the new iteration of Trump, which I think is a bit of a different person this time around. I'll venture to say that. What can we expect?
What can we expect? Okay.
It's a big loaded question.
Well, of course, we have to begin by recognizing that we don't know for sure that he's going to do what he said he would do.
Right.
And even if he does, we don't know which order he will do those things in. And the order would make a big impact on the financial markets. But one thing that I'm most excited about that he has said that he would do is back in September at a speech at the Economic Club of New York, he came out in favor of establishing a U.S. sovereign wealth fund, which I view as just extremely great news for the United States, and hope that he carries through with that very rapidly, because this is something I've been really calling for going back for 15 years. And in my most recent book, you just mentioned, it's called The Money Revolution: How to Finance the Next American Century. Well, how to finance it is to have the U.S. government set up a U.S. sovereign wealth fund and invest very aggressively in the industries and technologies of the future, and consequently to turbocharge U.S. economic growth so that the economy grows more like 5 to 7% a year instead of 1 to 2%, and to shore up U.S. national security, which is really now in grave danger as a result of the very rapid rise of China. China is overtaking us technologically, and it won't be long before they overtake us militarily. And if we do, in the not too distant future, although this sounds extreme, the United States could be conquered by China.
Wow.
And this is something that Americans need to begin thinking about and worrying about, and taking steps to make sure that that doesn't happen. And the best step we can do would be to have the U.S. government finance on a multi-trillion-dollar scale over the next decade investments in new industries and new technologies, things like artificial intelligence, quantum computing,
biotechnology,
biotech, nanotech, robotics, neural sciences, and things like developing fusion, cheap fusion. We could accomplish all of those things if the U.S. government financed this on a large enough scale. And it would bring about such extraordinary benefits for the American public. And what people need to understand about a sovereign wealth fund, what is a sovereign wealth fund? Well, of course, the government already makes investments in developing research and technology,
grants and so forth,
grants and that sort of thing. But the difference with a sovereign wealth fund is the government would actually take stakes in companies, listed companies and startup companies, and they would provide the financing, and these companies would be managed by the private sector. But as these companies, since they're so well funded with government financing, they would produce technological miracles and medical breakthroughs and create companies that would literally be worth trillions of dollars and could be listed on NASDAQ at $1 trillion valuations. And given that the government would have a big equity stake in these companies, this means that the American public would have a big equity stake in these companies and would benefit directly, financially.
First off, other countries have sovereign wealth funds. This is a common thing. They do investments. They act like businesses, right? Like a real fund, like any fund you'd see on Wall Street, right? Why doesn't the U.S. have a sovereign wealth fund? Is it because, and maybe I'll just bait you with a little bit here, because I can hear the clamoring now, well, especially from the right side of the aisle, which I tend to agree with more than the left, okay? But the government is just going to pick the winners and losers. Remember Solyndra, remember many things like that. Wouldn't it be the government getting into business rather than the government having its theoretical limited role of governing versus picking businesses? I mean, who gets to decide what companies it invests in? Wouldn't this just lead to a lot more crony capitalism?
So I think we should all look at this as the government acting as more or less a giant venture capital firm. Venture capital firms in Silicon Valley, they make investments and some of them fail, like Solyndra did, but some of them become so enormously profitable, like Google, that they pay for themselves and all the equity investors become billionaires.
Any venture capitalist knows that. You lose on 20 and you have one mega home run that's got a moat around it and, it knocks it out of the park. So that's the way to go.
Offsetting the losses from Solyndra, we have the gains from, for instance, the Manhattan Project and the internet, which may not even exist today had the government not developed it.
Yeah.
So we're talking about major breakthrough industries that could emerge as a result of this large-scale government investment. I know that in the United States, there's a fear of too much government involvement. But in the past, so going back to the 1960s, after the Soviet Union set on Sputnik, fear spread through the American public, and the American government very quickly reacted and started investing in new industries.
A lot of aerospace investment, the space program itself,
many other things. And so we won the space race.
Yep.
And out of the space race came spin-off technologies like calculators and computers, right? And that was enormously beneficial.
When I was a kid, I was a space cadet. I loved the space program. I watched everything, the Apollo program, the Viking program, all of that stuff really fascinated me as a kid. They say that for every taxpayer dollar spent on the Apollo program, $24 were put into the economy. So it was a 24-1 win. But I want to maybe go back to this, keep your train of thought. But, when you look at Sears and the way they use the U.S. mail, and you look at Google, which you mentioned, and the way they're using the internet, I don't think those companies have paid their fair share for the benefit they've gotten out of these government projects that enabled their business models, whether it be Google, Facebook, Uber, Amazon, et cetera. They're all using what we as the public paid for with our tax money. But maybe that's a tangent.
No, that's an important point. That is true. I mean, they say that Google's algorithm makes it the best.
Yep.
Came through government grants to the founders.
Oh, I wasn't even talking about that. I was just talking about the mere existence of the distribution system, the internet itself.
Right. So in so many ways, one of the problems is that the government has funded investment at the basic research and development level that has allowed the private sector to create companies on top of that and become enormously profitable. And then the companies, of course, hire lobbyists to ensure they don't have to pay any taxes. And so the government is not reaping the rewards that it should reap from making the basic investments.
They are reaping it into the growth of the economy in general. But specifically, I think these companies that have benefited from these taxpayer-funded projects should pay extra. This is just not fair that Netflix and Google get this free ride. And then, I can hear people saying, well, anybody could do that, right? The next Google's in somebody's garage today, right? But the problem is it's so unevenly distributed. It's just...
I agree with you, but even if we could get them to pay their basic minimum tax of, say, 20% of their profits, that would be such a huge step in the right direction and bring in enormous revenues.
Well, we've got to stop the offshore planning, the double Irish twist, as they call it, right? But that's another.
I try to avoid suggesting that we should increase taxes because I don't want to make enemies in the billionaire class. But one of the main problems is the government is now, as a percentage of GDP, it's only investing about half as much as it did in the 1960s in research and development at the basic level. So if it were investing as much as it did then I think this reduction in government investment in developing basic research and development. Corporations tend not to invest in basic research and development because it takes a long time for that actually to pay off. They wait for the government to develop the basic research, and then they jump on top of that and invest and create products, which is quite sensible from their point of view. But it's not great for the economy overall. I agree. So the government just needs to invest much more in basic research and development to begin with. And this decline in government investment, I think, is one of the reasons that we've experienced a slowdown in productivity growth over the last 3 decades, for instance.
Yeah.
And another thing to think about is, in terms of Americans not liking the idea of government being involved in business, well, okay, that would be fine if the United States were the only country in the world. We could just, do it the old way, go back to the 19th century and have no government investment, perhaps. But we're not living in an isolated world, right? We're living in a world where China's government is investing so aggressively in new industries and technologies that now they have overtaken us in many ways in terms of technology. They had 5G years before we did. They have such great electric vehicles and batteries and solar panels that we have to put up 100% tariffs to keep the electric vehicles out of the United States because they're so much better than the ones that our companies can produce and so much cheaper. And much worse still, they have hypersonic missiles and we don't.
Yep.
And so America has great private sector companies, fantastic private sector companies, but none of them can invest on the scale that the Chinese government can invest on. And the Chinese government is laser focused on dominating the future. And so it would be fine to dream about going back to some sort of laissez-faire Garden of Eden with no government involvement, but it would be suicidal. If you don't like government involvement in American way of life at the moment, I can assure you, you're going to really hate Chinese government involvement when they take over the country.
Yeah, that's a very good point. And you know what? The U.S. is very good at sort of taking the easy way to riches. These U.S. companies, our big famous companies, right? They don't build hardware. We don't build infrastructure anymore. We don't build Hoover Dams, Golden Gate Bridges, or anything. We build platforms and software. And this is really pretty easy stuff. When you go to China, for example, you're just struck and amazed by the level of infrastructure, the high-speed trains, the buildings, the skyscrapers. It's truly incredible. It's even incredible here in Bangkok. And Bangkok doesn't hold a candle to, Shanghai, right? It's just a whole nother level. But you go to Singapore, you go anywhere, and you see this kind of, I was just in the Middle East. I was in the UAE and in Qatar, and I was amazed at the level of luxury, the buildings that, the U.S. just isn't doing that anymore. And, you could say it's because of the environmentalists won't let us build anything, and that's partially true for sure. But I just don't know that these companies don't have the interest in funding these projects. So the government, I think, has to step in and do some of this.
I've lived almost all of my adult life in Asia. I moved to Hong Kong and started my career when I was 25 in 1986.
And what was the start of your career, by the way? Tell us.
So, I should jump back a little bit. I went to Vanderbilt, and when I graduated from Vanderbilt, I backpacked around the world for a year.
Yep. And you came here first as a backpacker at age 24. I know that.
That's right.
Yeah.
I was really, really lucky. I didn't have much money, and I found a job in Paris as a chauffeur driving around rich American tourists. And I made enough money to travel around the world for a year. And so when it got cold in Europe, I went to Egypt and Israel for a couple of months, right, and then to Thailand and Malaysia and Singapore for a couple of months in early 1984. And I could see it was already booming economically, and that there was very little competition. I would meet people on the streets. We couldn't read maps of their own city. So I realized, go east, young man. It's booming and there's not much competition. So I went back to...
Describe booming in the 80s. I know that China sort of started liberalizing from a business perspective in, I think, about 1978, if I'm not mistaken. But, we still had a Cold War raging. The Soviet Union didn't fall until, 5-10 years later. I don't know if you're talking about 85 here. But how were they booming?
So I spent 2 months in Thailand, Malaysia, and Singapore, starting off in Thailand and going south.
Well, Singapore was booming by then.
Well, that's what I was going to say. Singapore was the main eye-opener.
Right.
There, they were building...
It was incredible.
100-story skyscraper.
And, by the way, for those of you who don't like public-private partnerships, Singapore is the ultimate example of housing public-private partnerships because the government got very involved to solve the housing problem in Singapore.
Right. The Singapore economy has been completely government-directed, as was South Korea's. and Japan's and Taiwan's and China's. So
Japan had the demographic problem. China's coming into a demographic problem that may halt its progress to some extent. We could talk about that, but yeah, the government did take a very large role in these economies. You're absolutely right.
And in Singapore, they have two of the most successful sovereign wealth funds, GIC and Temasek, which have invested in these public companies and made the Singapore people much richer as a result and developed these industries, turning Singapore into an extremely wealthy city-state.
Yep.
But anyway, so I saw that right when I was 23, 24.
Yep.
And realized that Asia was the place to be as a young man. So I went back and went to business school at Babson College outside Boston for a couple of years. And as soon as I finished there, by that time I'd figured out that Hong Kong was the place to go. I hadn't been there yet.
Yeah.
So I flew to Hong Kong, and within a couple of weeks, I found a job as a securities analyst. In Boston, I'd worked for some fund management companies on a part-time basis, and they invested in Asian stocks. They were nice enough to write some letters of introduction to the English stockbroking companies in Hong Kong, right? Like Jardine Matheson, Hoare Gavett, and W.I. Carr. At that time, there were no American stockbroking companies working in Hong Kong, right? So I went to Hong Kong, went to these British brokers. They were very polite, but they wouldn't hire me because I had no education, no experience. They said, go work for a local Hong Kong Chinese company for a couple of years and then come back and see us. And so that's what I did. I went to work for a company called Chin Tung Securities.
Okay. And were you an analyst there as well?
I started off as an analyst there, doing research on the listed companies, right? And it was great. First year I was there, Hong Kong's economy GDP grew by 13%.
Wow. 13% in a year is incredible. It's nothing short of incredible.
And the first 12 months, the stock market went up 100%.
Wow.
It was glamorous beyond imagination. It was wealth unlike anything I'd ever even imagined.
Wow.
They said even then in the mid-'80s that high society started at 100 million US.
Wow. In the mid-'80s, after inflation.
Every other car was at least a Mercedes or a BMW or something.
Yeah, no, you really don't realize it. Like this sort of America-centric idea that, Americans tend to have. I'm guilty of it too. Of course, you just really don't realize how much wealth there is around the world. It is utterly amazing.
And in places like Hong Kong and Thailand, and in fact, most countries, it's very concentrated in a very few hands, right? So in places like Thailand, you have very, very wealthy families, and then the majority of the people, in Thailand, they're by no means impoverished. In fact, people here have quite a good standard of living, even in the countryside, but the wages are so much lower. So the wealth you see is held by the top 1 or 2%, but it's very noticeable and very influential and powerful, right? In terms of not only politics, but I was thinking more in terms of its power to invest and develop the economy.
Yeah, right. So how does this inform your view of macroeconomics? I mean, you're clearly in favor of more government involvement in the economy, sovereign wealth fund. I just worry about the government picking the winners and the losers, right? Because there's obviously all this cronyism problem. Or maybe these other countries that do it successfully, maybe they don't avoid that. They just have cronyism and they are picking the winners and losers. Is there less corruption? The U.S. never gets on a scale when you look at those surveys, the most corrupt countries in the world. You never see the U.S. as considered very corrupt. But what I like to say is our corruption in the U.S. is legalized corruption. It's legalized through lobbyists, through winner-take-all system largely. Now, granted, it's not as concentrated as you mentioned and as it is in some of these other countries. But there's definitely a wealth concentration problem in the U.S., I would say. It's getting worse.
I mean, you're not wrong when you say that I'd like to see more government involvement in investing, and that's certainly true. But I'd like to see the government provide the financing and then provide that financing by investing in listed companies and startup companies like a venture capital company does.
Right.
So that the private sector actually manages these investments. The best American entrepreneurs and the best scientists would be managing these companies. And the government would just be funding them on a very large scale so that they could create rapid breakthroughs.
Would the government basically give money to VCs who would pick the companies or to investment bankers? How would that work? Or would it be literally a politician picking that they're going to put the money in this company? I mean, it's like Pelosi is on.
All the other sovereign wealth funds in the world, they are managed by investment professionals that are chosen ultimately by the government, of course. But you would have set out to try to get the best investors from the private sector to do their patriotic duty and join the board of the management of the sovereign wealth fund, like there is a board of Temasek in Singapore. Right? There's a board that manages Norway's sovereign wealth fund. They have the largest sovereign wealth fund. And they have, of course, oversight committees, but you have these people allocating money on a very large scale into the private sector. Now, where does the money come from?
Yeah. The U.S. has the easiest task in that department of any country of all because we have the reserve currency. So
we have the reserve currency.
We're very lucky. Yeah.
And also, we have the recent experience of very large-scale quantitative easing,
right,
where the Fed just creates the money and buys government bonds. So not only 3 or 4, 5 years ago, the Fed was creating $120 billion every month through quantitative easing.
Yeah. Wow.
And during the pandemic, during 4 or 5 years, they created $5 trillion from thin air. Now, since then, they destroyed $2 trillion of that $5 trillion.
Yep.
This is an enormous amount of money. And this is where we could obtain the funding to seed our sovereign wealth fund. Just as an example, the U.S. Cancer Institute, which is charged with curing cancer,
right,
its annual budget is $6 billion a year. $6 billion a year is not curing cancer.
Right.
$120 billion a month was how much the Fed was creating. $6 billion is 5% of $120 billion.
Yeah. And that's a year versus a month, by the way.
Yeah, precisely. Right. So that's how we could fund this. Now, people are worried about inflation, but after 2008, when we had the financial crisis, you'll remember that the private sector collapsed. All the banks started to fail, all the car companies started to fail, and they had to be saved by the government, right, to prevent a new Great Depression. Well, at that time, the government intervened with trillion-dollar budget deficits, failing out the private sector. Let me emphasize the private sector failed.
Absolutely.
And had to be saved.
But a lot of people objected to that, corporate socialism. They said, you're socializing your losses and capitalizing your gains, right? And part of it is the problem is the way these executives and the boards of directors work. And I remember during TARP, there was a lot of talk about capping salaries and stuff like that. And, I think if you're taking government money, that's a different deal, right? I'm all for free market capitalism. If your shareholders in your company want to let you earn $1 zillion, more power to you. If your board approves it and your shareholders keep investing, okay, right? You must be creating value. But if the government is giving you money, if it's our tax dollars, you should not see this kind of corporate greed. It's just inappropriate.
Well, I think the big critics who criticize this crony capitalism, or what you refer to it as, they need to understand what would have happened if the government had not bailed out all the banks.
The whole moral hazard.
Or it would have been a Great Depression.
I agree with you. I know. Kind of like you had to do it.
25% unemployment.
Listen, you probably agree that they shouldn't have let Lehman fail, right?
Probably shouldn't have.
Yeah. No, I mean, look, if they're doing this, they might have well have done it across the board. I agree. I know what would have happened would have been devastating. But I'm saying you get there because in the back of their minds, these companies know that they can take insane risk and then they're just going to be bailed out, right? That's the moral hazard problem.
Well, let me put this into a bigger, broader perspective on how I reached this conclusion.
And then we got to get on to what to expect with Trump. So we'll get there.
So I very strongly believe that we have an enormous credit bubble.
Yeah.
Not only in the United States, but effectively globally. So big, in fact, that if it pops, then it's probably going to be such a severe blow that our civilization would collapse.
And this is why you coined the term creditism, which say is different than capitalism. We used to have capitalism. Now we have creditism.
Right.
And you talk about creditism 101. You teach this. So I definitely want you to tell us what creditism is and how it varies.
So when I say that I think we must have government investment to make the economy grow faster, the reason I believe that is because the alternative, in my mind, is that this bubble is going to pop. If the bubble pops, effectively, we die.
Yeah.
So that's, we do have a big bubble. The Austrian economists are right in that respect. A lot of credit creates economic booms. The booms turn into bubbles. The bubbles ultimately pop. They popped in 1930.
Yep.
We had a 10-year depression, 25% in unemployment. The Nazis took over Europe. The fascists took over Japan and took over Asia. We had World War II and 60 million people died. That's what happens when a big bubble pops.
Yep.
And the government doesn't prevent that. In 2008, the same thing almost happened again. But this time, instead of letting the bubble pop into a Great Depression and World War III, they did the opposite. They reflated the bubble. And that worked very well. Our $1 trillion budget deficits, $3.5 trillion of paper money creation, reflated the economy, recapitalized all the banks. And here we are, 16 years later, richer than ever before, with a much larger economy. And at that time, there was no inflation. We only had, at the peak, inflation hit 3.8% in 2011. All right. By 2015, it was back down to deflation again for a couple of months in the first couple of months of 2015. So that was round one. Then we had COVID. Once everyone was locked at home, if the government had not intervened, then they would have defaulted on all their mortgages, credit cards, car loans. All the banks would have failed again, and we would have been in another Great Depression. But instead, the government followed the playbook of 2008 instead of the playbook of 1930, and they kept the bubble inflated. And so here we are now 5 years down the road, and we didn't collapse. We've got 4.2% unemployment. We've got the greatest expansion of wealth. It makes the mind boggle how much wealth has increased. Since 2008, the net household sector net worth, the wealth of the Americans, has increased by more than $100 trillion. Wealth in the country now is $167 trillion, up $100 trillion since 2008. Amazing. And in fact, just over the last 12 months, wealth has increased by $17 trillion. Okay. Since COVID, since the end of 2019, wealth has increased by $52 trillion in less than 5 years. $52 trillion of wealth creation. That's enough to pay off the entire U.S. government debt. 36 trillion, some left over. With 16 trillion left over. Right. So we've got a wealth explosion that is more or less the direct result of this extraordinary fiscal stimulus that hit the economy in 2008 and especially in 2020. And all of the money creation.
So if someone called you a Keynesian, you would not be insulted then, right? You're okay. You like the Keynesian idea, right?
So Keynes, was in a different age.
Yeah, sure.
It was a gold standard.
Yeah.
And budgets were more or less balanced. Keynes advocated when the economy got weak, the government should spend more, and so that it didn't collapse. And when the economy got strong, the government should tax more, so that over the cycle it evens out, went back into balance. Yeah. What we've experienced in the post-gold standard age, after we stopped backing money with gold, is something altogether different on a much greater scale. That's beyond anything Keynes had even dared fantasize about.
But you're okay with reinflating the bubble for sure. You're in favor of that, right?
If we don't keep the bubble inflated, then it's going to
Is it a matter
horrific consequences.
Is it a matter of degree, or is it just an ongoing principle? Because, people will say these are like memes, okay? So forgive their ridiculousness, but raise minimum wage, and then people will argue that'll just cause more inflation and more unemployment, which there's a valid argument. You can't hear the dogs that don't bark right away, right? But, instead of paying people $20 an hour, why don't we pay them $1 million an hour, right? Instead of bailing out during COVID, if it's, I don't know, the number is $16 trillion or something, right? Why not make it $100 trillion? I mean, is it a matter of degree, Richard, or who decides how much is enough?
So I'm not in favor of, raising the minimum wage to a very high level. What I'm in favor of is more investment in new industries and technologies to create a technological revolution that will power the economy and create medical breakthroughs and technological miracles, cure all the diseases, expand life expectancy, and shore up U.S. national security so that the first American century is not the last, but only the first of many.
Yeah. So you would not be in favor of, ridiculous welfare programs and wasteful spending. You're an investor with government money, right? Would be your clarity.
This brings us back to creditism.
Yeah.
What is creditism? The economy we have today is a very different thing than the economy we had before 1968. Up until 1968, dollars had to be backed by gold. The Fed had to actually hold gold to back every new dollar that it created.
Yeah.
But in 1968, the Fed didn't have enough gold to continue doing this, so Congress changed the law and they removed the requirement that the Fed hold gold to back dollars.
Right.
And after that, this fundamentally changed the nature of our economic system in numerous ways. First and most obviously, the Fed was no longer constrained in how much money it could create, making things like quantitative easing and $1 trillion of money creation possible.
Yeah.
But more difficult to grasp at first is after that, trade between nations no longer had to balance.
Right.
Up until then, the U.S. trade was more or less in balance because when dollars were backed by gold, if the U.S. had a trade deficit, it would have to send its gold overseas to pay for the deficit. Gold was money, so the money supply would have contracted, and that would have thrown the economy into severe recession. So they would have had to buy far less from other countries, and trade would have come back into balance.
No current account deficits allowed back then, right?
That's right, yeah. But once this ended, it didn't take the U.S. long to realize that it could buy a lot of things from other countries, and it didn't have to pay with gold anymore. It could just pay with paper dollars or more real estate.
That was a great deal for the United States.
Treasury bond is denominated in paper dollars. So by the mid-1980s, the current account deficit had grown to 3.5% of GDP. And by 2006, it had grown to 6% of GDP. That was $800 billion in just 1 year. And this year is going to be $1.1 trillion. So since Bretton Woods broke down in 1971, the cumulative U.S. current account deficit has been $16 trillion. That means the trade surplus countries, like Asia, have received $16 trillion that they wouldn't have. And that's why you see skyscrapers all over the place.
Right.
That fueled the Asian miracle.
Right.
That transformed Asia. That's why China has fantastic infrastructure everywhere. This money created a global economic boom.
Oh, it lifted 300 million people out of poverty as of like 15 years ago. I mean, it's more now.
And it was extremely disinflationary because suddenly we were buying things from very low-cost workers.
Right.
Countries with very low-cost workers. Yeah. So when I saw Hong Kong in 1986, I would go across the border. And even then, in 86, you could factories as far as the eye could see, full of young women working
in Shenzhen
for $3 a day.
Right. Yeah.
And so it was very clear this was going to drive down inflation and drive down, therefore, interest rates in the U.S. And that's what happened as interest rates moved lower, made asset prices go higher.
Why did the rates go lower?
Well, as the inflation rate moved.
Oh, okay. Just general inflation was lower.
Right. So in the early 80s, inflation was double digits.
High. Yeah. Great.
And so they had to keep interest rates at double digits.
Yeah.
But as the inflation came down, then the Fed cut interest rates. And very often during this century, the Fed has been more worried about deflation than inflation.
Yeah.
And so this really changed the whole paradigm. We no longer had a closed domestic economy to operate within, a closed domestic U.S. economy. Then, say in the 60s, if the government had spent too much money or the Fed had printed too much money, this would have led to full employment and full capacity utilization at the car companies, the steel companies, and all the other companies, and it would have led to a way to push inflation.
If it was always domestic.
If it was domestic.
Right. But we were able to import deflationary pressure in terms of products from especially China, but other overseas countries. We keep importing cheap labor from largely Mexico, right? And that's a deflation import to offset inflationary pressures that would be there if you weren't doing that. But China's now equalizing. Wages have come up a lot in China. So how long does this last?
Well, I would say that in India, I don't know how many manufacturing jobs there are in the world.
Right.
200 million, 300 million.
Yep.
There are more than 300 million Indians who would work for less than $15 a day.
Yeah.
So this lasts for generations and generations. There is no end in sight to ultra low cost labor.
Okay. And then the question is, how much do we need labor with automation and our AI is now automating all kinds of softer things?
So this completely changed the whole paradigm. We no longer had a closed domestic U.S. economy. We had a global economy that had a workforce that was 25 times larger, right, but earned 90% less. Yep. And so there was no worry anymore about the government overstimulating the economy, either through massive budget deficits or through paper money creation.
And you're saying that can go on for a very long time?
As long as globalization persists.
And what part of globalization? Cheap labor?
Yes.
Okay. And, they're looking at Africa now, I think, because Chinese wages have gone up, but Africa's a mess. It's a bunch of different languages. It's just too difficult. India's not as difficult. I mean, you got the elephant and the dragon, right? I remember the first time I went to India, I read that book on that trip, actually. It's interesting, but India's nothing like China. In terms of, India's democracy, right? It's much less efficient. It doesn't have the manufacturing base. It's not the same.
But in the meantime, we have Vietnam and Indonesia and Bangladesh, which are all becoming quite big powers as a result of this shift from manufacturing out of China, where wages have gone up to a shocking $25 a day.
Right, which is still not much, but
to places where there's still less than $5 a day, and probably in places like Bangladesh.
Yeah, right. Okay, so we've got creditism. That's the economy under which the whole world operates, or just the U.S., the whole world, right?
Creditism fuels the global economy. So what creditism is actually is before dollars ceased to be backed by gold, we had capitalism for the most part.
Yep. I want you to contrast creditism with capitalism. I was just going to ask you to do that.
All right. So under capitalism, the government had very little involvement, theoretically at least, and gold was money. And businessmen would invest, and some of them would make a profit, and they would accumulate capital as a result and reinvest that capital. And that's how the economy grew, through capital accumulation. That's why they called it capitalism.
Right.
But that's not the way our economy works. Those are not the forces that drive our economic growth anymore. What drives our economy now is credit creation,
right,
and the consumption that it makes possible. So credit also started to explode after dollars ceased to be backed by gold. Total credit, which is the same thing as total debt. In other words, the debt of all the sectors of the economy in the United States.
Public and private.
Public and private. The government, households, corporations, Fannie Mae and Freddie Mac, corporations, non-corporate businesses, state and local governments. There are really only about a dozen or 10 that matter. Okay. Sectors. Add them all together, that's total debt is equal to total credit. Okay. Total credit first went through $1 trillion in 1964 when I was 4 years old.
Right. And I'm thinking back to that was when the Diners Club card was the thing, right? Credit cards. I mean, just those cards that we all take for granted. That used to not be a thing.
Right.
I mean, it wasn't that long ago that the first credit card was the Diners Club. That was the first
just
card.
saying early credit cards.
And the idea that you could go to a restaurant and pay with a credit card was just weird.
So we've gone from $1 trillion of credit in 1964 to $101 trillion now.
Yeah.
So in 60 years.
Which is about the size of the global economy. The GDP of their whole planet is just over 100 trillion.
Yeah. So we've had this explosion of credit.
Yeah.
And credit, rather than capital accumulation and investment, credit creation has become the thing that drives the economy forward.
Yeah.
In fact, between 1950 and 2009, anytime total credit adjusted for inflation grew by less than 2%, the U.S. went into recession. So we needed at least 2% credit growth adjusted for inflation to keep the economy out of recession.
Right.
Every time it fell below 2%, we had a recession. That happened 9 times.
Right.
So as credit grew much more rapidly than the economy, we went from something like 150% total credit to GDP up to 360% credit to GDP. Yeah. And as the credit expanded, that's the thing that drove the economy.
Yeah, I got to tell you, Richard, my thinking is very much in alignment with yours, because I remember during the Great Recession, I'd be watching CNBC in 2008, for example, 2009, and I wanted to throw a brick at the television set because every talking head was on there talking about money supply, money supply, money supply. And I said, why aren't you talking about the credit supply? That's what dried up. I mean, in my real estate company, when the mortgage meltdown started, which, by the way, was the first phase of the Great Recession. That was not the same as the Great Recession. It was just the entree to it. And I knew that was going to happen. I predicted that in 2003, 2004. And everybody was arguing with me. You just knew these liars' loans were going to default. I mean, that was obvious.
It is obvious.
But I didn't know what the Big Short was about. I didn't know what was going on behind the scenes on Wall Street with, CDOs and selling the same loan off in different tranches multiple times in different pools. And that I was unaware of. I had no way of knowing that stuff was going on. But it was the credit that dried up. And then everybody talk about how, they stopped publishing M3, right? Which was one of the money supply indicators.
Yes.
And they thought that was a big conspiracy because, they just don't want to tell us, what's going on with the money supply. And that's why they stopped talking about M3.
Right.
Speak to that for a minute if you're...
So you're exactly right. I mean, no one should focus on the money supply anymore.
Yeah.
Because
it's the credit supply that matters.
In the past, the
money supply matters, but the credit supply is more elastic than the money supply.
Well, there's really no difference between money and credit anymore.
Right.
Money used to be backed by gold. It used to be gold. Now it's just another type of credit instrument that typically pays no interest.
Yeah.
So money is just a M1, or let's say the base money.
Yep.
Is just a fraction of the total credit supply. It's the total credit supply, not this minute bit of the base money that really drives the economy now. And if you look at the chart of total credit, as I mentioned, from $1 trillion to $101 trillion now, it never contracts, except in early 2009, it did just a little bit. And that's when we had the crisis. That's when the bottom almost dropped out, as it did in 1930. But this time, the government jumped in with trillion-dollar budget deficits. And since that time, of the total increase in credit, roughly $52 trillion of credit since then, I think, the government has been responsible for half of the credit. The growth in government debt has provided half of the growth in total debt since 2008. In other words, without this increase in government debt, credit would not have continued to grow. So the economy would not have grown. In fact, without the increase in the government deficits in 2009, 10, 11, 12, and the QE that financed that, credit would have contracted. Creditism then would have imploded, and we would have spiraled down into a new Great Depression.
Yeah, it's an inflationary depression. So deflation, by the way, in my opinion, is the worst of all economic maladies. Nothing is worse than deflation because it's hard to stop. And it gets into this really scary cycle where nobody wants to spend because everything they have will be worth more later. And so they don't want to spend it. And then you have like this double hit. And it's treacherous. You can't handle it. Inflation is much more tolerable, but deflation.
So policy is going to be very important over the next year. It's going to be very interesting to follow. So that's what I do in my video newsletter.
Yeah.
MacroWatch.
Excellent, by the way. Yeah. I love MacroWatch. You know, I've been a subscriber to MacroWatch for a very long time.
Thank you very much.
And folks, let me tell you, Richard does a phenomenal job. First of all, the free component of his email newsletter, then you get to click through and you see whole slide presentations. So you've got the visual and you've got him talking about it. And I'd really recommend, I think you have a discount for people. So by the way, I'm not making any money off this. Hey, it's not a sponsor or anything. So
I started MacroWatch 11 years ago. It's a video newsletter. Every couple of weeks, I make a new video. The last one I did yesterday is 20 minutes long. It has 50 charts that you can download.
Oh, they're excellent.
And it's describing something important happening in the global economy and how that's likely to impact asset prices and economic growth, with a lot of focus on credit and also money creation and government policy. And how government policy is going to affect credit growth and money creation and what that's going to do to asset prices. There are now more than 100 hours of videos in the MacroWatch archive. If your viewers are interested, they can find MacroWatch on my website, which is richardduncaneconomics.com. And if they'd like to subscribe, hit the subscribe button. They'll be prompted to put in a discount coupon code where they can subscribe at a 50% discount.
That's a fantastic offer.
And it's very affordable. I'm sure your viewers would find it very affordable. As we discussed earlier on in the conversation, our economy just doesn't work the way it used to work when gold was back, when money was backed by gold. Our economic system now is driven by completely different forces and has a different dynamic that you're going to learn in your classical economic textbooks.
I agree.
And what I try to teach in MacroWatch is the way that the economy really works now in the 21st century. So that's what MacroWatch is all about. I hope your viewers will go to richardduncaneconomics.com and at the very least sign up for my free blog there.
Yeah, I'd really recommend it. And, you know, your point is so well taken, Richard, that so many people are playing by old rules and they don't realize the game has changed. For example, on one of my strategies that I've been teaching for 21 years, inflation-induced debt destruction, you know, so many people are playing by their parents' or grandparents' playbook, which was true in their day before we went off the gold standard, right? When that tether was finally severed in 1971 on August 15th by Richard Nixon, everything changed. The whole game changed. And you've illustrated that in our talk today in many ways in terms of trade and international relations and geopolitics and so forth. But on a personal level, it changed and people are playing by old rules and they are just missing out. So that's one of the great things MacroWatch has taught me, and I'd highly recommend it to people. Richard Duncan, thank you again for being on the show, and it's always good to have you, especially in person.
Jason, yeah, thank you for having me. It was great to see you.
All right, my pleasure.